Welcome to the Commonwealth Home Ownership Podcast, the real estate investing podcast for Canadians. Whether you're a seasoned investor or just getting started, you've come to the right place. If you're looking for a way to take control of your life through real estate investing, stay tuned and be sure to join us at cwho.ca, your hub for all things real estate investing in Canada.
Hey everyone, welcome to another episode of the Commonwealth Home Ownership Real Estate Investing Podcast. I'm Phil Wong. With me as always is Brad Price, and joining us again is Kim Nguyen. Thanks for joining us again, Kim.
No worries. Thanks for having me.
So let's do an info session this time around. So I'd like to talk about, the rules changes have affected the mortgage lending space a little bit. Made it hard to qualify, priced out some of the people who may have been able to purchase mortgages. So I want to talk a little bit more about the private lending side and how that may be able to, that side of the financing, how that may be able to help some of these people close on some of these deals. And if we can, I'd like to talk a little bit more about reverse mortgages down the road. How's that sound?
For sure. Sounds good.
Okay. So Kim, what have you seen in terms of creative strategies to get around this financing barrier for those who have been priced out by the new rule changes?
So just so you know, before I jump into that, I'll kind of give a brief recap, right? So
yeah, for sure.
the new qualifying rules that came into play is before, what would happen is you would need to have enough income to support a mortgage with an interest rate of 4.79%, or the actual interest rate you're going to get from the lender plus 2%. Usually 4.79 is the rate that they default to. Now the changes is that the 479 has increased to 5.25%. So with this new rule change, it shaves approximately 4 to 5% of your actual purchase power. So kind of, some clients who are just on the cusp, like they're basically out of the cusp now, right? They either have to lower the home that they want to buy or just not buy at all, right? So what we've been seeing now is a lot of different strategies to kind of maneuver around that. And one of the examples that I want to share today is I had a client of mine who bought a new build. And as you know, we've talked about this previously on podcasts before. New builds have skyrocketed in prices, right? And it's unfortunate. Phil, yeah. I know you know all about it.
I know, man. Some new builds I purchased earlier in the year, they've gone up, close to $50,000 for the same build.
Mm-hmm.
And it's, sometimes for some of them it just doesn't make sense anymore, which is too bad. But
yeah,
it's tough.
And that's the thing too, right? Like with the skyrocketing prices, there comes a pro and a con to it, right? Obviously the con is, yes, it's gonna, cost you more, but what if you already had a contract that was made already, right? What if you already had a contract where this was before the crazy price increases? Because with my client situation, what happened was she got her hands on a new build home, and this was pricing before the crazy jump, because the crazy jump after was approximately 50 grand, give or take, right? That was the next phase. So with my client here, with the whole stress test qualifying rules being changed on her, in her situation, she needed a 30-year amortization mortgage to make the deal work. That was the only way that this deal would work. But in the mortgage realm, in order to get a 30-year amortization, you need to do a down payment of 20% down. My client here, the most that she could scrape was about 5 to 10%, right? That was kind of the max, and that was pushing it. But luckily enough, though, what we were able to do to kind of spin the deal around was, with private lenders, I'm not too sure if many of you guys listening today know, but private lenders, they don't really have a minimum in terms of down payment. There are actually some that will allow you to do a down payment as little as 5%, right? Given that there's equity already built up in the home. So in my client's case here, because she bought a new build and she knew that the prices have already gone up, they know that, the same person looking to buy her exact home tomorrow, they're going to be paying close to 50 grand more, like right off the hop, like they will. And maybe the value might even be higher than that. Who knows, right? Just based on the comparables in the market. So what we did in this situation was, for her closing, we were able to, do a 5% down with a private lender just to close on the mortgage. And it worked out pretty nice because with all the fees involved, because she didn't have to pay the CMHC fee, she actually saved money by going down this route. And the exit strategy was she just closed with the private lender. And then in return, the day that she got the land titles, we then transferred that back to an A lender. So we structured it like a refinance, aka a transfer. We used the higher stated value, and then we did a refinance for 80% loan to value because the equity has already been built in. And
Mhm.
at that case, even with the new stress test, because we were doing the refinance and qualifying her at the 30 years, the deal was there. So
That's
things
awesome.
like that. Yeah. It's strange. It's very backwards, right?
Uh-huh.
But there are ways, especially if there's built-in equity.
So a couple questions then. One, there's no minimum term for these private lenders then.
No, there isn't. There's some that will do um, fully open, right? So
Okay.
really, the next day, if you need to bring it out, you can.
And how long was that bridge loan that they needed before they refinanced?
Basically, it was just about 15 days because of
Okay.
land titles. Yeah. So land titles, usually they, unfortunately, I'm sure you guys have all seen it. Land titles is very slow in Alberta.
Hmm.
And usually their lifetime is about 9 to 10 days. But in this case, it ended up being about 15 days.
That also leads to the question: will a bank factor in the fact that there's equity built into the home
Of
when
course.
they? Yeah, yeah,
Yeah.
but for example, like at the beginning, like because they needed the private lender to close the loan first, to close the mortgage. But will the banks would is this something a bank would do, like knowing that the price would increase? Would they do an appraisal knowing that, say it's $50,000 more, give you use
Yeah.
that equity as
As like a
part
part of a down
as
payment.
part of
No.
a down payment? Yeah.
Fortunately, no. And again, a very common question I get asked too, because a lot of clients will be like, "Okay, Kim, I'm buying a new build or whatever house it is," and then we get the appraisal value back. And usually, I share this with my clients. I'll be like, "Hey, like great news." For an example, I actually had a resale. A client of mine, we closed the home. It was a home out in Auburn Bay. I'm sure you guys know where that is. Very nice area. The appraisal came back, and usually, myself as a mortgage broker, I always share that result with my client. My client, in the time span of when they wrote the offer to when we did the appraisal, which it was a 3 week delay there, just because we were changing some of the financing. But that 3 week delay there, the home value went up $60,000 in Auburn
Wow.
Bay, and I was like, "You just made 60,000." I'm like, "You owe me dinner now, okay?" But the question I had for my client was, "Okay, well, Kim, if my home is worth that much, like, do you think I could drop my down payment, right? We can use some of the equity to kind of offset that, or can I, request for a higher loan amount? Like, could I utilize that in any way, shape, or form?" And unfortunately, when it's a purchase with a standard bank, no, you cannot utilize it. It's just good information knowing that you made money, but they won't utilize it until you close a transaction. The only way that you can tap back into it is if you close a transaction and then you did a refinance at that point.
So in that case, in today's market with these rapidly rising home prices, you could technically get into a house with almost no down payment if the house price is increased enough by going through a private lender.
Oh, totally. 100%. Yeah. If the conditions are right, then 100% you can.
So if we can back up just a second here, because I feel like this, if it's too sounds too good to be true, it normally is. So Kim, if I go and purchase a house right now with a private lender because I'm not able to qualify with a big bank per
Mhm.
se, okay? So the big bank says no, you don't qualify, but I then go purchase it with a private lender. The home is then worth $60,000 more, and I go back to the big bank to get a typical mortgage or standard mortgage. Are they just going to say to me, yes, your home's appraised at a higher value, but you still don't qualify? And now I'm stuck with this private, expensive
Mhm.
financing. Where's the line in the sand here?
The line in the sand is, I always say, you have to work with a mortgage professional to run the numbers on both cases, right? Going back to my previous example, like I knew the mortgage amount that she needed to borrow would work if we could just use a 30-year amortization to qualify, right? That was the secret sauce there. That was the biggest thing. Like I needed 30 years to qualify, and her income was more than enough to service it. So that's why, like, the challenge is no, don't just go out to a private lender and buy any home. You have to still run the numbers. There's still criteria that you have to work with, because once you get the mortgage with a private lender, yes, they don't really have any criteria, any rules surrounding that. But the moment that you jump and move it over to a regular lender, There's the TDS rules that come into play, like the GDS, and also your credit as well too, right? You still need to have good credit in order to qualify with a big bank.
Mhm. So yeah, so qualifications still key,
It
although you
is.
just might be able to rejig some of it to maybe use less of a down payment upfront.
Exactly.
Okay.
Exactly. Correct. Yeah. And again, too, like, I mean, if that's not the situation, like other things that we could look at would be maybe going towards like a B lender right away, right? So I've had clients where in their case, 2020, we all know was a very tough year for many, and many had, income loss, job losses, maybe reduction in wages, all that good stuff. And maybe 2020 wasn't the greatest year for income, but and with this new stress test coming in, it's going to be even harder to qualify. So another route that we've seen was, maybe you need to go to the B lenders for maybe a shorter period. Because keep in mind, like the moment I say alternative lending or B lending, a lot of people freak out and they think you're handcuffed for years. But again, you want to think of it almost like a band-aid strategy where, it's just very temporary. You could do something where it's only maybe 1 year term, and then after the 1 year, as long as your income has gone up, maybe at that time point, you now qualify with a regular bank because your income's back to normal again. And at that point, we can just move you out of the B lender to the A lender, right? It should just be a band-aid solution just to get you into the home that you want, right?
Mhm.
Yeah, so if you're in this position whereby you need to use private money, you can qualify, you've been through the assessment, so to speak, and you can qualify based on the 80% loan to value, the 30-year amortization after the fact.
Mhm.
That's going to put you in good stead to kind of implement this type of strategy. But what sort of interest rates are we going to be looking at if we are going to go through this private money, and what do we have to allow for worst case scenario if it I don't know, could take a month or two to actually complete the secondary financing to get that typical mortgage in place. I mean, how much money do we need to allow every month to cover that interest, and what's that going to cost?
And that's the key thing too, right? It's all about preparation. You don't want to just jump into a private lender just because. You need to have a proper execution plan. You got to have that exit strategy, because private lending isn't cheap. It really isn't. And again, usually rates, depending on if it's a deal where we're utilizing the equity in the home to get financing, in most of those cases, your interest rates will be in the double digit, right? So keep that in mind, double digits. While yes, it's interest only payments. So whatever your loan amount times it by the interest rate, that's what you're paying. Like it's interest that's compounded daily, but it's hefty though. It can be very, very high. And that's why, again, you have to be able to execute it properly. Whenever you're looking to go into private lending, I never like to see my clients in there longer than a month or 2 months, right? Especially if we're utilizing this type of strategy, because at that point, you're burning so much money. Like it's a high interest rate. You're buying a home with a credit card at that point, right? It's only meant to be, kind of like a bridge, like what Phil mentioned, a bridge. So that way, once the title is transferred, you've got that built in equity and you know that equity is there, you jump right out of there.
I guess for those who are unfamiliar with private lending, I mean, it could be anywhere from 12 to 15 or
Yeah,
higher percent per month on, a $300,000, $400,000 loan. So you guys can do the math. That is a lot of money per month,
it is, yeah.
right?
And there's fees up front as well too. So keep that in mind, right? Most private lenders, they will charge upfront fees, and those fees could be anywhere between 2 to 3%. Now, some of them can roll it into the mortgage, but again, most of them will ask for that upfront too. So just make sure you set aside that money as well.
Mhm.
Yeah, and it's important to note that while you do have the flexibility with the open term, um, and also payments can be interest only a lot of the time, because they do realize like a principal and interest payment is just not conducive typically to actually complete the deal. But the interest is calculated most of the time with simple interest, so it's a very easy thing to calculate for that term. So if you are looking at holding it for a couple of weeks, do your worst case scenario, hopefully no longer than a month or two, but you can utilize simple interest calculations at an interest only payment, so that you know exactly the money you need to set aside, as well as the upfront fees, like you said. I mean, we just went through this scenario on a deal that we waived conditions just recently, and it was the same thing. It was a really challenging deal to put together, and we we had all of those options in front of us because we had to have those options ready to decide and pull the trigger, because it just was, everything was coming down to the wire, so much so that we had to, push out our condition waiver date, and also move the possession date. We had to move the possession date a month, which thank goodness the seller was okay and open to doing. We got the deal done, but we ended up going with a B or a monoline lender, because they were willing to work with us on a shorter term. They gave us a fairly decent interest rate, and it was almost like a halfway to, it was a halfway option to allow us to actually restructure the deal in 12 months' time based on the situation of the people involved in the deal.
Exactly.
So I think it's really important to understand that there are these other options out there. But just back to your comment, Kim, you don't want to be holding private money for a long period of time. So you really have to strategize and organize yourself, that you have backup options should you need to utilize those.
Mhm. And for those of you listening who are unfamiliar with the way interest is calculated, there's a difference between the simple interest is just basically flat rate of interest. So say you have a $100,000 loan at 12%, that means it's $1,000 per month. It doesn't compound over the course of that year, right? Whereas there's compound interest where after the first month it'll be 101,000 interest, 12% interest on 101,000, then 102,000 after the second month. So simple interest is just easier to calculate and much friendlier on the borrower.
So Kim, let's flip the script here again. What in this current landscape we're in, there's been talk and information flying around about reverse mortgages. So we're talking about private lending, we're talking about B-space monolines, and now there's this, almost feels like a new thing, but I'm sure it's been around for a little while, in reverse mortgages. So how are reverse mortgages playing into this whole thing, and maybe what are they?
Yeah, so believe it or not, like there's a boom now with reverse mortgages. So again, to give some context, with the new stress test rules, right now it is tougher to qualify, right? It's the interest rate is higher to qualify. So a couple ways to offset that is, if you really, really want to buy the home, sometimes you have to cough up with a higher down payment, right? And right now, if you've got your savings, you're depleting it towards a down payment. Where else are you going to get this money from? Where most clients are, especially in the millennial side, they're going towards their grandparents. Grandparents, or even just parents in general. And what their parents are doing is, because they own a home, like most cases, they own their own home, and there's a lot of money just trapped into the home that they're living in. What they're looking into now is something called a reverse mortgage. And what a reverse mortgage is it's based on age. So usually, we call it a senior's mortgage, right? Because you have to be at a certain age to tap into this. And the older you actually get, the more money you can take out. And the way that it works is, the money that you take out, the reason why they call it a reverse mortgage is, you, the borrower, you don't pay anything. Okay, you don't pay anything until the home is sold or until you pass away. And usually, when you pass away or when you sell the home or whatever the case is, at that time, the accrued interest is when you would pay that. So, for an example that I like to use is, if you've got a client here who's got like a free and clear home, usually for a reverse mortgage, depending on your age, roughly they will give you about 50% loan to value. So if your home is worth, let's say, 500,000, the reverse mortgage lender will give you 250,000. That money is literally just deposited to you as a lump sum. And what we're finding is, parents or grandparents are actually taking that money to help their kids. They're using that because they're not paying any interest on it right away. There's no monthly payment, nothing. They don't pay anything until they sell the home or pass away. And they're taking that 250 and they're saying, you know what, kids, you need to buy a home. You need to get your foot into this market because it's crazy. Take this money and use that as a down payment, and use it for a down payment, right? Get yourself qualified and get yourself a home. But in the back end, though, like with the reverse mortgage, like I said, it's a very unique tool that many are utilizing now, because parents, they're tapping into that equity, and they don't have to make any monthly obligations to it. So it's actually quite nice for them. They're helping their kids out. And again, when the home sells, that interest accrued is taken care of behind the scenes, basically on the back end.
Just out of curiosity, then, how much interest? What's the interest rate of these reverse mortgages typically?
Yeah, so it works the same way as a mortgage where there's different terms, right? So you can
Okay.
either take 1 year term, 5 year term. There's also some that offer variable rate terms, but the interest rate is higher than your standard. So right now, as you guys know, we're seeing rates in the 1%. But when it comes to a reverse mortgage, we're seeing rates in the 4% range, 4 to 5.5%. That's kind of the range that you want to work with.
Okay. And it's still calculated the same way, like biannually, compounded?
Yep,
Okay.
still the same, still the same. It's just the main benefits is, and think of it this way, if we have senior or elderly retired parents right now, their income stream is already low, right? There's only so much that you get from CPP OAS. And if you have children that need that extra help in getting into the home ownership market and they just need that extra down payment, this is a great way to help them out.
Kim, are there risks associated with reverse mortgages? Because I recall something in the UK quite some time ago where they had a similar setup, and for example, if you leveraged 50% of the value of the home, okay, but over a certain term, interest rates increased, and all of a sudden you get, however long down the road, and let's just say, for example, the interest accrued on top of the already leveraged debt
Mhm.
actually becomes the full value or more than the value of the house. Is that a real risk with
Not
these?
here. Yeah, not here. And I'll tell you why. Like they're very smart. The ones that have created this reverse mortgage, the older you get, the more money you get access to, right? So as I mentioned, the maximum loan to value is usually between like 50 to 55% loan to value, right? And the reason why that is, we have a life expectancy, right? So that's why the older you are, the more money you get because they know you're not going to be holding on to that loan very long. It's either you're going to be moving out to a senior's home or like I said, the inevitable happens, right? Death happens. So that's why as you get older, they're willing to lend you more. Whereas someone who is, freshly graduated or not graduated, retired here, maybe they're 70, you're not going to be able to tap into 50% loan to value. The most that you would get would be maybe around 20% loan to values because they know, like I said, your life expectancy and the chances of you, going to a senior home this early is quite slim, right? Or you selling the home is quite slim. So that's why, the younger you are, you actually don't get that much, but the older you are, that's when you get a large lump sum. And that's how the lenders protect themselves. And in that situation that you mentioned, Brad, I think that's why programs like this are very similar around the world, but it's just Canada has one of the most strictest, they're the most strict, I feel like, because they really gauge it by age, right? That's how they do the lending.
So what is the minimum age that someone can apply for a reverse mortgage?
Yeah, so they say 55, but again, honestly, at that age though, you're not getting anything. So it's very, very minimal. So that's why I usually say, like with a reverse mortgage, honestly, it only makes sense if you are like the sweet spot, I would say, like between like 75, 85, like then you're getting a decent amount. But if you're younger than that, looking into this, you're not going to get too much.
That is smart because you're pretty much near the end of your life expectancy at that
Yeah,
point.
it sounds morbid, right? This is a very
Yeah.
morbid podcast that we're having, but unfortunately, that's how this lending works, right? It's very, very strange, but I mean, it's a really good utilization, right? Especially we're seeing this happen a lot in our neighbor BC because again, house prices are so crazy there, and we're seeing it in Ontario as well too. So a lot of my Ontario buyer clients, like they're getting a lot of help from family because as you guys know, there's so much equity tapped into there, and the nice thing with reverse mortgage is when you've got retired parents, you got to remember their income isn't what it was like 10 years ago, right? They're retired now. So maybe they're part-time or they're just solely earning, Canada Pension Plan or OAS. That's it. And if we were to go to a traditional bank and get like, let's say a line of credit, they won't qualify, right? To get that kind of loan amount, they will not qualify. The nice thing about reverse mortgage, it's solely based on age. So they don't care about your credit. They don't care about your income. It's all about your equity in your home and your age.
So that being said, is there like a mortgage, is there an amortization or
There is
a
still an amortization. Yeah,
attached to it?
yeah,
25 years? Okay.
yeah.
What,
So
what about what about maximum term? Is there a maximum term as well?
there is, yeah. So every lender is very different, but usually the 5 year term is the most attractive that most will sign on to.
Okay. And is it typical that after that 5-year period, that those mortgages would be extended? Because I can't see, I can't see a parent pulling out a couple of 100,000, putting it in, or loaning it as, or giving it as a gift to their children. They're then purchasing a property with it and leveraging more capital. I can't see that new purchase in 5 years is maybe going to be enough to pull the money back out to pay that debt off. So like how does that work in that situation if the people that are first initially borrowing the money haven't sold the property or they haven't passed away?
Yeah, so in that case, it's just a renewal, a straight renewal. It'll be like, here's your new rates and terms, and that's that. And one of the reasons why this program is really successful is, as you guys know, in real estate, your property appreciates year after year, right? Assuming you have a good home, it should appreciate year after year, and that's the whole logic behind, the lenders that offer the reverse mortgage, because they know as the years pass, like your home value is going up, 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 up. Like, yes, there's still going to be interest tied to it, but again, like it's on the basis that your home value is going to go up. So you will be able to walk away with something, right? You're not going to sell the home and that's it. You have nothing in your pocket. That's why the loan to value is so low.
So if you were to break a mortgage term because you die, there was there a penalty attached to that as well?
Yeah, it's a penalty. I know it's kind of strange, but yeah, like with anything, right? There is a penalty that is attached to it.
Okay. I mean,
And
yeah, it's a good strategy though, just to at least, yeah, just to get those down payments, or even as a bridge loan
Yeah.
for, if you're doing if you're doing a finance, if you're doing a project, you just need a little bit of money, a little bit of cash to do a flip or to do a bridge loan in order to get proper financing. I think that's a good way to do it.
Totally, yeah.
ye-
And like I said too, it's just like their idea is that, like, if you have like a younger client, right, maybe in their 70s or something, like they're still working part-time, like their idea is eventually this client is going to probably want to downsize, right? Like if it's a larger home or something, the chances are our parents, like, they will want to downsize, right? Who wants to live in a 2,500 square feet home for the rest of their life? Like, they're going to have such a hard time up with the upkeep and cleaning. And most of the time with seniors, we find the general trend is either they sell their home, right? And they move into a senior's home, or maybe they move in with one of their children. So in one way, shape, or another, like that home that they have will eventually be sold somehow.
yeah, I almost, just kind of brainstorming a little bit here, but I feel like it could be a really good option to do like new build projects as well, like construction projects. Instead of utilizing construction financing, which can be a little bit expensive at times, it could be a really good option for somebody that's, in that world and maybe has access to the parents or grandparents' equity in their homes to fund projects they might be working on. Just kind of moving on from that thought, are all the banks doing, like, who's doing this? Are the big banks doing this? Is this monoline B lenders? Who's
That's a good
private?
question. Yeah. So no, like the big banks don't offer it. So usually if you go into a big bank and say, hey, I want a reverse mortgage, they'll be like, we don't do that. So right now in Canada, there's only two providers. So one of them is Home Equity Bank. And again, you need to be in touch with a broker in order to access it. And same thing with Equitable Bank. So Equitable Bank also has a reverse mortgage as well too. Both of them are pretty similar, and there's still word on the street is that there's going to be some more lenders that are going to be introducing projects that are very similar to reverse mortgages as well too. Again, that's to come in the future, but so far there's only two key players, but the key is that you do need a broker partner to be able to access it.
And how do these banks view, or sorry, let's say for example, Kim, I'm able to borrow, let's just say $250,000. Okay, so I'm in Vancouver, I borrow that and I use that for a 25% down payment on a $1 million property. How does the lender view me in terms of where I got my down payment from? What
Gifted.
does that look?
It's gifted, right? So if you are looking, so the one thing that you have to remember is, if you are taking this money as a gift from your parents to buy a primary residence, that is a-okay. Lenders don't care where it comes from, right? Like, what they care about is, Brad, you yourself can fill out a gift letter. Your parents, grandparents can sign at the bottom saying, yes, I gave my grandson, like, 250,000, right? As long as they can sign that actual gift letter, lenders don't care. Where it gets complicated though is if you are looking to buy a rental property, majority of lenders do not allow rentals, period, end of story, right? So that's something that you have to keep in mind. If the purpose is for you to buy a rental property, down payment cannot be gifted, right? So that's the one thing that you have to remember. While there are some lenders that do allow gifted down payments, a majority of them, if they know your down payment is gifted and not own funds, they will not proceed.
If the money is in your bank account for more than 3 months, and you can show that 3-month history, uh, you know, and then they don't see the lender doesn't see where it comes from, would that bypass that rule?
It would, right? So essentially, you have to remember too. So it works out the same where if, let's say, you had an early inheritance, and that's something that is actually very common in today's day and age too. So part of the reverse mortgage is actually most of the grandparents giving out their grandson, granddaughter money. Is this is part of a living inheritance, right? Like they're still alive. They, in their will or whatever, it mentions that they're going to give us X amount of sum to, their granddaughter or grandson. If that money's been in your account and you're just letting it sit there, at a time period, lenders will view that as good as your own money, right? Of course, if it is a sizable amount, like even though it's been in your account for quite a few months or years or something, lenders do have the right to ask, like, hey, where did this come from? Like if you were, if you're a cashier or something and you had just 300,000 sitting in your bank account, sometimes lenders, they know that, given your profession and stuff, it might be kind of unreasonable. Like they may ask, like, where did this money come from? But again, too, like generational wealth and inheritance, it's a common thing that they do see. So if it has been sitting in an account in a certain time, for a certain time period, yeah, for sure, like that's good as your own money. But if it is less than that, then for sure it's shown as a gift, right? It's short term.
And is it just a gift letter, Kim? You mentioned that, a document that your grandparents or your parents sign. Is it just a gift letter? Does it need to be notarized or anything like that?
Nothing. So that's a great question. And I get asked that question quite often. Like, do I just type up this format myself? Like, where do I get this? And really, every lender has their own gift letter. So keep that in mind. So there's nothing that you can Google gift letter template. Do not do that, right? Trust your mortgage broker, get the deal approved. And with whatever said lender that your financing is with, they will have their own format that they will send to you directly for you to print off and get filled out and signed.
Yeah, I signed one a little while ago when I bought my first home, with the intention to live in it. And yeah, it was just like a little, it's like
Letter.
just like a letter. It's just like a one pager that you
Yeah.
literally say who's where the money's from, who is it getting money to, saying that they do not expect the loan to be paid back. It's
Exactly.
100% a gift, and then they sign off, and that's it. Yeah.
There you go. Interesting.
Mm-hmm.
Awesome. So, Kim, is there anything else that our listeners need to know about reverse mortgages?
I think the one thing, as I mentioned multiple times too, is just it is a great tool, especially if you're in the market and for someone who may be just strapped for qualifying and you want to get your hands on that first property and you just need some assistance. And if you have parents that have equity, let them know that because maybe their income may be lower because they're retired or whatnot, there's still financing options. Because I know usually clients will go into their bank and be like, hey, I want to get out a line of credit or I want to do a refinance to, help my kids out to buy their home or whatever the case may be. And most of the time, the banks have their criterias, right? They need to make sure that you have enough income to qualify for this equity takeout is what we call it. And sometimes if you don't, just don't give up, don't get discouraged, look into the reverse mortgage option. Yes, it sounds kind of weird where, the interest rate is higher and you pay that stuff after, like behind the scenes at the end of the day. But if it's an opportunity to kind of help out your kids and maintain your lifestyle, because again, there is no monthly obligation, right? Your cash, your budgeting is still the same. Like there's no extra obligation that you have to pay. It could be a really good tool to utilize.
Mm-hmm. I have a question though. I mean, I saw these ads for reverse mortgages a little while back, saying how it's a great way for seniors to supplement their income
Yeah.
in their later years. But is there a detriment or is there a downside to the seniors doing, like, taking a reverse mortgage on on their side.
Nothing. Yeah. One of the biggest myths that we hear all the time is, oh, if I take this money out, that, I'm not going to get that much for CPP or OAS. The government's going to think I make too much money and they'll cut back all my benefits. Absolutely not true at all. So if you need it, take it, right? That's the one thing. But if you're just taking it just to do nothing with it, I don't recommend it, because remember, you may not be making a payment on it, but again, there's still interest that's accrued, right? You're going to have to pay it somewhere, somehow. So, but it is definitely a nice way, though, just because we all know on average in Canada, I'm not sure if you guys are aware of this, but the average retiree gets about combined maybe 1,200 a month, and that's CPP and OAS combined, right? That's not a lot to live with, considering, look at it, our inflation, right? Everything's so expensive these days. And again, their pension has always been this amount. Like, the increases are very nominal compared to, what the real cost of things are outside, right? So it's a great way to, like I said, maintain your standard of living. And if you have that equity, and again, like, you want to tap into it, but banks are saying no, because if you're only making 1,200 a month, like, you can't qualify for much at a bank. You really can't, right? It's very little that you can qualify for. This is a great way to utilize that and tap into it.
Okay, so bottom line is it doesn't count as income, correct?
No, it does not. No.
Okay. So Kim, is there anything else you'd like to kind of add to this whole private lending, the reverse mortgage
Yeah.
session? Anything our listeners would like to know or should know?
I would say, if like we talked about the reverse mortgages and that, going back to the whole private lending world, if that is a strategy that you may be interested in, just the one thing is, you don't want to be caught with your pants down. Okay, you have to have a good exit strategy, and in order to do that, like, you got to work very closely with your mortgage broker, mortgage professional, just to ensure that there is an exit, right? The last thing you want to do is be stuck in there. So work with a trusted professional, right? And you have to ask them all the questions about, like, different strategies to getting out, right? And just making sure that there is a valid strategy in getting out, and making sure that's feasible, right? People can promise you the stars and the moon, but again, make sure you get your facts straight. Like, you gotta grill them, and you gotta make sure there is a pure exit.
Yeah, great information, Kim. As always, I just love having these conversations. There's just so much to talk about. But hey, look, we really appreciate you taking the time to join us and share the info.
Perfect. Thanks, guys. Thanks for having me.
No, thank you, Kim.